Interest rates, I think, has definitely had an effect on, people's decisions to sell and to move and all that kind of stuff. And property values have gone up because of the supply constraints. And even with rates going up, it hasn't made much of a difference. It hasn't taken the prices down. So
welcome back to Keeping It Real Estate. I'm your co-host, Mike Roeder, and today we have Peter Neill joining us on the show. Peter has a significant amount of real estate investing experience, and him and his partner, Ron, have amassed approximately 90 residential real estate rental properties. And today we're going to dive into why they love single-family rental properties. So with that said, Peter, welcome to the show.
Mike, thanks very much for having me. It's an honor to be here and looking forward to the conversation.
Certainly. So first off, Peter, I'd love to hear a little bit about your background, where you grew up, how you got into real estate investing, how you met your partner, Ron. If you want to start us off with that, that'd be great.
Yeah, wow, that's a big question, and I'll dive into all of it. So I'm a Philly guy, born and raised in the suburbs of Philadelphia, Delaware County. So we're all feeling the pain of the birds, what they did to us over the last couple weeks here. Grew up in the suburbs of Philly. My father was a property manager for CBRE, so that was kind of my first introduction to real estate. He managed, all a commercial portfolio. So when he retired, he was managing a portfolio of Bank of America's, and all growing up, he managed office buildings and industrial and that kind of stuff. And growing, it's been snowing out here right now recently, and stuff like that, snow, rain. The elements, it would be 2:00 in the morning. He'd be up and on the phone, and I'd hear him, talking to the crews and getting people where they need to be and stuff like that. And, just dealing with a lot of issues and problems and all kinds of crazy stuff that comes up, when you're managing properties, and especially banks. You wouldn't believe some of the crazy things that happen, from bed bugs to, people going to the bathroom at the ATM machine and all kinds of stuff like that. So I just thought, man, I don't know if real estate's for me. I don't know if I want to do that. So I went to school for broadcast, telecommunications, and mass media. And I thought I was going to work in like the TV business and do that kind of stuff. And when I got out of school, I ended up taking a job in marketing for a distressed mortgage investment company. And I didn't even know what the heck that was. I took the job. I thought they were good people, and it was literally walking distance from my house. So it was really convenient in that sense. And little did I know that was going to take me on the path that I am today. So there was my introduction to a totally another world of real estate and the investing side of the business. And I learned real estate in an interesting kind of a different way from the distressed mortgage angle. And I worked direct. I was like the right-hand man to the CEO and one of the founders. And he had a lot of real estate investments, and he had his own single-family portfolio, did a ton of fix and flips, and commercial property investment and raise capital for and stuff like that. So, and they run a investment group where they would bring all kinds of different investment vehicles in and stuff like that. So I was exposed to just so many of the different opportunities out there beyond just distressed mortgage investing. And even my introduction to affordable and workforce housing came through that job, and like some of the stuff that the CEO was doing on the side in his own portfolio. So made a lot of great connections there. My primary job was raising capital, which gave me I love raising capital because you have to know a little bit about everything in order to be successful with it. So it really, and I was selling courses and selling individual notes. So yeah, I dealt a lot with students who were going through and learning the process and all that kind of stuff. So I got a really good foundation in the distressed mortgage business, which is backed by residential property. So that was, learned a lot about that. And then as the business transitioned, they were buying a lot of seconds, and then they transitioned to first mortgages. I saw a lot of what it took, because a lot of people think seconds first. It's all the same. It's all dead at the end of the day. totally different business. Strategy can be completely different. So I learned a lot of times with first, if the homeowner's not paying, chances are they can't afford to. So a workout agreement might not be possible. It certainly is in some occasions, but sometimes it's not. And a lot of times those properties can be vacant. So there's no exit through the borrower in that sense. So then you're taking the physical property back. And one thing I saw was the importance of having control over the physical property management, being able to execute on physical hard asset management. That's what kind of led me to my partner, Ron. He's been a contractor for over 20 years. He had crews in play that he's been working with for many, many years. So he really knew that side of the business. And I'm not a handy guy. I mean, I could barely screw a light bulb in. I when I go over to my properties to do work, I don't even do it anymore because I'll spend an hour and then I end up having to call somebody. So I'm just, I've learned it's easier for me. It's more efficient, money and time wise, for me to just call somebody and get them over there. But Ron's not that guy. I mean, Ron is a hands-on, like before he's got obviously on the finance side of things now, the investment side of things. But for years, he was on site and really learned the ins and outs of the construction business and not only doing everything, but then managing crews and things like that. So as a fundraiser, as somebody who was looking to gain more control and to have, start my own thing, a partnership with somebody like him just made a whole lot of sense. And obviously you're in real estate. It's a small world. We ended up knowing a lot of the same people. It was kind of a funny story how we got introduced. I was looking at doing a sports facility development a couple towns over. He sits on a board of a sports marketing company, and a friend of mine was like, oh, you should meet him. And as we got talking and as we got to know each other, what he was doing with single family affordable housing was really, really interesting to me. That was something that I had always had an interest in, and he was actually executing and having success in that space and had a really cool strategy and model. So for a couple months, we just spent time getting to know each other, driving around to properties, checking in on different projects that he had going on at the time. He was doing a lot of fix and flips when I met him, keeping some as rentals. And we decided to launch our first fund in November 2019. He was kind of, just using personal money, leveraging some family and friends' money, that kind of thing, and wanted to take things to the next level. I had the experience on the fundraising and capital management side of things. So it just kind of, and branding and marketing and all that stuff. So it just kind of made sense. And that's what led to GSP, and now we're on our third and fourth fund. So that's kind of the kind of a long overview of of who I am, what I'm doing, and how I got to where I am, that kind of thing.
Well, I appreciate you sharing that, Peter. And I just wanted to run through a couple of points that stuck out to me. First off, you were talking about when your father was, property managing and handling office and industrial and dealing with a lot of problems. And I think a lot of, people out there that are interested in getting involved in real estate, there's going to be constant issues, whether you're in single family, multifamily, industrial, there's always issues that pop up. I mean, right now there's a big freeze down in Texas. And so we have burst pipes on a bunch of properties and you have to work through those problems. But one thing to keep in mind is if you're going to self-manage, these properties, regardless of what type of real estate you're taking on, you're going to have to deal with those problems. So just take that into consideration when you're getting into the space. Do you want to be a passive investor? Do you want to leverage a third-party management company? Or possibly, like you guys have done, do you want to fully vertically integrate and create your own management company and create those systems and those processes? So I thought that was a crucial piece of data that you shared there as well. And then you also mentioned, the importance of having control over property management. You caught that when you were in your job. And I completely agree with that. We'll get more into that in just a bit. And then you also talked about, spending a couple of months with your partner before you really dove in and opened your fund and whatnot. And, I applaud you for that. I think that's crucial. Spend as much time with your potential partners as possible before, marrying that partner, so to speak. So great information there.
That's a great way to put it. It is definitely a marriage in a sense, and you got to have shared values, and you have to have shared goals. And for us, we ebb and flow well. There's things that I'm good at that he's not, and there's things that he's good at that I'm not, and it works very well. And we have a good age difference too. mean, I'm 31, he's 50. So just a lot of different experience. I mean, he's been investing a lot longer than I have, has gone through, especially in the current interest rate environment and things like that. Like, he's been there, done that, went through '08, invested throughout the '90s. So I always think that's another, to kind of go off of what you're saying on the property management side. If you can partner with somebody who's been there, done that, who's gone through different cycles, who's had properties come full circle, has a lot of different experience, I mean, that's extremely, extremely helpful. And that was something I learned at the company I worked for before, starting GSP, was, leaning on people who have been there, done that, and finding ways to add value to them, and that people pay for, masterminds and things like that as well. I definitely think there's a time and a place for that. Not everybody is going to be as fortunate maybe to meet somebody who's going to take them under their wing and show them everything. It's not always that simple, but it's just like anything. You gotta jump in and do it. Because I think from your point you made about the property management, sometimes it's best to just work with a property manager, but you still gotta be hands on. I mean, you can't just think you're going to hand things over to a property manager and they're going to make decisions for you. You still have to make the call at the end of the day because they're spending your money. It's not like they're fixing a toilet on their dime or something like that. You know what I mean? Like, so you're still going to have to make a lot of decisions. And in order to make smart decisions, you got to have some intelligence and data and like past experience to go off of. So it's, if you're going to go down that active path, I think working with smart, experienced people that have been there, done that is a great way to do it. Having some of those people in the holster to be able to call and that kind of thing helps out a lot.
I completely agree. And yeah, like you said, you have to be hands-on, whether you have a third-party property management company in place or you have your own property management company set up. If you take your hands off the wheel and you let someone else do all the work,
sure,
your property is likely to slip. And, does that mean that your NOI drops by 10% or does it mean it drops by 30%? It's hard to say. I think it depends on the management company you have in place, but just make sure that you're always hands-on. I know for us, we have a weekly management call where we're dialing into all the KPIs and just, making sure that we know exactly what's going on in these assets on a weekly basis. The other thing that I wanted to mention too, when you were talking about your partner and, how his strengths complemented yours, one thing I would recommend is have a personality test done when you're looking to possibly partner with someone. We do Gallup surveys.
Yeah.
For our team or anyone that we're looking to bring on at Granite Towers. And, it shows you what their strengths are, what their weaknesses are, and it'll really tell you a lot about that individual. So that can be a nice tool to use as well. So Peter, let's shift over a little bit to, your single family portfolio. So on this podcast, a lot of times we're focusing on the multifamily space. It's what we're fully ingrained in. You guys focus on single family rental properties. And we were also talking before this podcast, you have some smaller multifamily properties as well. I would love for you to give me the rundown on why you like the single family rental space and what the benefits are of that space for you guys.
Sure. There's a number of different reasons that we are very much in love with the single family asset class. At the end of the day, I think it probably boils down to supply and demand. There is, in the markets that we're in, there's a ton of demand for single family, 3, 4, even 2-bedroom properties. There's certainly housing stock, but there's not enough to go around. And there's been, in Philadelphia especially, there's been a huge apartment boom, a lot of supply coming on the market over the last couple of years. Every time I'm in the city, there's new apartments going up. It's not that way in the single family space. You know what I mean? So there's a lot of, they're trying to make up for the gap between new housing starts and new housing formation through more and more multifamily units. And it's helping in some way. But at the end of the day, there's a lot of people want to live in a single family home. They want to have that, the privacy that comes along with it, that kind of thing. So in the markets that we play in, there's just a very high demand for single family. And then we love the flexibility to it. When we buy, we like to buy, properties that we can either fix up and sell, or properties that we could fix up and hold. And we tend to hold, and we tend to have a lease, and we tend to do Section 8 rentals or workforce rentals, which are non-subsidized, but still like middle of the road, middle income, not luxury housing, like that kind of thing. So we like that flexibility to be able to make a decision. Do we want to sell this property, or do we want to keep it as a rental? And then the financing, there's a lot of flexibility there, so we typically will raise capital through our funds, use that capital for the acquisition and the development cost, and then we'll do portfolio refis. And a lot of our portfolio refis throughout the years have been 30-year AM, 30-year fixed mortgages. So that's having a fixed rate for 30 years, especially in the interest rate environment we've been in over the last couple of years. That's great. So we like that for that reason. And then at the end of the day, it's just doing what you're good at, and what you're built out to do, and not always getting tied into, the next shiny object or something like that. Like, we have our own crews. We have, boots on the ground. We have a very powerful South American workforce that, guys that really want to work, and they're flexible. They don't necessarily care where they live, depending on their situation and their family life and all that kind of stuff. So they'll move around. So single family for our strengths makes a lot of sense, but multifamily does too. And a lot of it is how much capital are we raising, and what is the better thing to do? Is it to deploy? If 100,000 comes in, do we go buy, a property for 30 to 70,000, put 70-30 into it? We can have that deployed in, a couple days. Instead of having to save up a bunch to go put 30% down on an apartment complex or something like that. So there's a number of different factors that go into it, but I would say it boils down to supply and demand at the end of the day. We're not really developing new single family homes when it comes to like urban metropolitan areas. Even in the suburbs and places, especially outside of cities, that the land is becoming more, it's more and more developed over the years. So it's harder to create more new single family homes in the markets that we're in, at least. And then a lot of the new ones now throughout the country they're doing a lot of built to rent communities and things like that. So there's just a lot of demand for single family homes, especially in the workforce affordable housing side. So that's one of the things that attracted us to the space. And, I think one of the reasons you see institutions like Tricon and Invitation Homes and American Home for Rent and all those companies that, people will say like, oh, well, they're not buying as much. They literally can't find much more properties to buy. Like, they've bought them all. There's not much more. So they're developing a lot of these rental communities and things like that. The other thing too is if they can't deploy 50 million or 150 million or up, they don't even want to do it. So developing build to rent communities, which are very similar to multifamily complexes at the end of the day, in their efficiency, in the scale and the efficiency, and having them in one place, is a good strategy for them because of their finance and their capital. But there's a ton of opportunities and great deals out there in the scattered site space, which we tend to play in. Not that we don't take advantage of small portfolios and mom and pop portfolios and that kind of thing. And there's advantages to buying those types of portfolios because of in-place cash flow and upside. But scattered site individual properties where, especially if you're buying blighted homes where you're not really competing with a regular home buyer, because they're not going to buy a property for sub 50,000 and then put 100 into it or something like that. So then you're revitalizing the community and you're providing a quality rental or a quality resale, for that market where there's a ton of demand. So that's just a few reasons why we really like that space.
Makes sense. And yeah, I like that you mentioned supply and demand, because it can be so different from market to market, sub-market to market, city to city. So really tune into that if you're looking to start, investing in real estate. I think about multifamily. There's, like you said, there's a lot of units coming online. However, the new permitting has dropped by about 50%. So you look, 2-3 years out, and rent growth should really take off because you're going to have a huge shortage. And I think the same probably stands for single family properties because interest rates were so high, for the last year, there's probably less being built would be my guess. Plus we had
Definitely,
supply chain issues as well. Is that what you're seeing, Peter?
100%. I actually had some notes from a webinar I did next to me. A big part of the problem, 08 really stopped the residential development the way that it was prior to 08. So we were developing a ton of houses before that. After 08, we just stopped it. I mean, so the gap between single family home, like new construction to household formation, so new households that are created to how many new houses that are created, at this stage of the game, it's over 6.5 million homes. So it's just, there's a huge gap between that. And then when you look at, like, to take it even further to the workforce, affordable housing, and that too depends on the market you're in. You'll see, like, affordable housing in California can be a $500,000 home. You know what I mean? Like, affordable housing in Texas or, some of these locations can be 400 grand. In the markets we're in, you're usually looking at like sub 250. And if it's less than 4% of new houses constructed were sold for under $200,000. So we're building a lot less homes. And when you take it even further, we're practically building nothing when it comes to properties that are under $200,000. So it's very difficult. I've been my brother's been looking for a house. He's got a wife and a baby now. And, they're living in an apartment and they're looking for a house, and they both corporate America, really good jobs, all that kind of stuff. And there is just nothing in the suburbs of Philadelphia. You know what I mean? You either need to be upwards of $1 million and to even find anything. It's really, really difficult to get into a property even in that 500 to 700 or so range. It's difficult. And a lot of people with in-place interest rates over the last couple of years and before, they're naturally low rates. I mean, so they're kind of imprisoned in the sense that they don't want to sell the property. They might get a great price on the property because of the appreciation, but then what are they going to do? They feel like they're going to overpay, for their next house, and then the rate's going to be double, triple what they're at right now. You know what I mean? So the interest rates, I think, has definitely had an effect on people's decisions to sell and to move and all that kind of stuff. And property values have gone up because of the supply constraints. And even with rates going up, it hasn't made much of a difference. It hasn't taken the prices down. So, and that, I don't know, I can't speak for every market, but that's at least what we're experiencing in, the markets that we're in.
Yeah, no, I would have to agree. Same up in Minnesota. Texas seems to be the same scenario as well, where prices really haven't decreased much on single family properties. And what are your thoughts as the Fed possibly cuts rates in 2024 and 2025? Do you think the pricing of single families will go up with those rate cuts, or any?
Yeah, I think it could. You know what I mean? I think you could see. If rates come down, you might see some of the people who have been kind of, sitting on property because they were afraid to sell, take their property to the market. So you're thinking, okay, there might be a little bit more supply come on. So could pricing potentially come down? But then you have a lot of people like my brother, a lot of, younger people that are looking to buy, that have been on the sidelines, are not looking that seriously, if they're looking at all, because of where rates were, now coming back on. So I don't see anything in the markets that we're in where you're going to see a very significant price, change in either direction. You know what I mean? I think we're past the COVID, craziness, where you had these absolute, these markets that appreciated 20% in a year or more, that kind of thing. I don't think you're going to see that, because there's just nothing happening that's going to create that kind of appreciation. But I think you're going to continue to see, and we're in the Mid-Atlantic, so we're on the East Coast. We're in Pennsylvania, Maryland, New Jersey. We didn't experience the massive appreciation that they did throughout the Sun Belt. But we've experienced consistent tick up, and I like that. It's not as stressful, it's very consistent. And then because of that, you don't receive the pullback either, like the kind of hockey stick type appreciation where it's up and then it goes down. And same thing with rents. Like, we didn't see, these massive, unbelievable, certainly saw huge appreciation in rents, but not, absolutely insane. Not 200% or something like that. You know what I mean? So we haven't really experienced that pullback from there either. So that's one of the reasons I like the Mid-Atlantic market. One of the reasons we play in that space is because we do all the construction in-house, and that's where our crews are, and that's where our experience is, that kind of thing. But, that just comes back to knowing your market and knowing, like, seeing where your supply is at and that kind of thing. But that's one of the things I like about affordable housing. I don't see anything happening on a state and local level. I don't see anything happening on a federal level that's really going to add much more supply all of a sudden. And there certainly has been, Biden's administration has brought some money to the table for affordable housing, but it tends to be in the multifamily world. And it tends to be these large hedge funds and developers that access that money, and they tend to want to develop and spend a good amount of money. So it tends to be multifamily apartments, and a lot of that stuff is studio, 1 bedroom. You're lucky to get a 2 bedroom, that kind of thing. So it doesn't meet that demand for the families with kids that want to be in a single family, attached or detached home, and have that level of privacy and level of space, that kind of thing. So it'll be interesting to see. And I mean, too, like with, your recession talk and all that kind of stuff. And I think that's one of the reasons I like the affordable housing space, because I think it's probably the most recession resilient asset class at the end of the day. Everybody needs a home. And when you look at the data compared to other types of real estate, from industrial to even market rate apartments and retail and office and all, affordable housing tends to do the best through those times, probably just because of sheer demand. They already have so many people in that pool that need housing. And then, like, during recession and things like that, it just adds to that demand for that type of housing.
Yep, I completely agree. There's a massive amount of demand for affordable housing right now. And I only see that, increasing as we go into the future, because like you said, even if there are new apartments and new single family homes being built, at the price point that those are being built, very, very few of them are, catered to that affordable housing group. So keep that in mind. And, you had mentioned, back when COVID was going on, we saw some massive appreciation, in certain markets. And I think one thing that you can do, or one thing you can tune into, is the one-way U-Haul reports, and then also United Van rental reports. And that just shows, who's moving where and who's booking, one-way rides. And that can kind of allow you to kind of get in front of the ball at periods of time. So, with that, Peter, I'd love for you to share a little bit more on economies of scale. So, we focus on apartments. It allows us to gain economies of scale because we're buying hundreds of units in one spot. How are you guys able to do that in the single family space? And, tell me a little bit more.
Yeah, well, it's funny. It actually, I think it works a lot in the same way. You know what I mean? So that's one of the reasons we syndicate the single family. And, in many ways, we've kind of built the rocket ship over the last couple of years, and now we're adding the fuel to it, because the economies of scale and the efficiencies that are created at scale in the multifamily space is exactly the same in single family. So the larger your portfolio is in the single family space, the more efficiencies you're going to have, the more key in-house hires you can have, or, maybe if you do want to work with a third party asset, property manager, the larger you are, the more interest they're going to have in wanting to work with you, the more leverage you're going to have, all that kind of stuff. Usually when you work with those people, how big of a client are you for them? You know what I mean? That's what's important to them. So we look at it the same way as multifamily. I mean, the larger we can make our portfolio, the more efficiencies that are going to be created, the more key hires that we can make, and you're just spreading the risk around at the end of the day. And I mean, you're not only geographically spreading the risk around, but from a tenant perspective, not all of our tenants are subsidized. That obviously provides a certain reliability, consistency to rental income and collections. But you're also, if you have 2 properties and one of your tenants go down, something happens. It could have a lot to do maybe with your tenant screening, maybe it has nothing at all. Things happen, life happens, and somebody loses a job or gets in an accident or a family issue, whatever it is. Now all of a sudden you got 50% isn't paying, So it's just like, that's a huge problem. Now, if you got 100 properties, you have 200 properties, 1,000 properties, you got a couple people not paying. It can absorb that hit a lot better. There's also economies of scale created on the construction and the property management side. Like, we don't ever buy one refrigerator. You know what I mean? We don't buy, we don't go to Home Depot and buy a couple boxes of flooring. We're buying pallets of flooring. We're buying, 10, 20 refrigerators at a time. And we look to find those wholesale type discounts. And then, we have them, but we're also looking to not only grow our rental portfolio, but to grow on the construction and the property management side, because that also helps us to be efficient as well. So we work with mostly investors. We do some residential work as well on the construction side of our business. So that keeps our crews busy. It helps us to bring new guys in and test them out and that kind of thing. And then on the property management side as well, if we're managing other properties, we have turnover and things like that. It's just keeping us busy. It's keeping us buying. It's getting us, where we can buy larger, wholesale and get discounts and things like that. So I think that's not a normal thing for most people. They're not going to if you don't have a team and you don't have the right resources and people in place, it's going to be hard to scale a single family portfolio. But if you look at it as a business, you have a team of people, you have the right resources in place, then scaling is a very important thing in the single family space. And it creates a lot of efficiencies and economy of scale. So it's very similar to multifamily in that sense. My advice to a normal person would be more about buying right, in the sense of, are you really getting a deal on a value add, or do you just think maybe you're getting a deal? You know what I mean? Like, a lot of what we do is those bladed properties where we're going in and we're full renovation. We're practically handing over new construction to our tenants. So the maintenance requests and the maintenance calls are nil. we don't have a lot of those issues because they're moving in, everything's new. The other thing, when you have value adds, are you putting lipstick on a pig? Because that's gonna, once somebody's living there and they're using the bathroom and they're using the kitchen and they're using the HVAC, or then you're going to have those problems, as they're there, especially as they're there longer, they're going to come up. So it's about, what is your abilities? How much can you handle? And then having really proper reserves aside to handle any of those things that come up. The same thing too is, like, we do outsource stuff as well. Like, we use third parties for our HVAC. So we'll use subcontractors as well for certain projects where it makes sense. And when you have 100 properties or more, and don't even have to have that many, when you're calling your plumber or your HVAC guy or your roofer or your handyman, whoever it is, he's going to pick up your call and he's going to get back to you. Whereas if you only have one or two properties and you might call the guy once every 6 months or, once a year, and you probably don't want to call him that much, right? I always joke with that when I call my plumber for my own stuff. It's just like, it's good to hear from you, but it's also not. Like, I hope I don't talk to you again anytime soon, that kind of thing. So it's hard to have that leverage with contractors if you don't have scale, because if you're not a big client for them, they'll get to you when they get to you, and their pricing, is probably going to be steepest with you compared to maybe somebody else who's given them a lot of business. So there's definitely a lot of efficiencies that come along with it. But obviously then if you're doing it yourself, there's a lot of management and a lot of, just things that you need to put in place from a resource perspective, with different technology, from property management tools and, utilizing Excel and systems and processes and things like that you really have to have in place to keep that efficient. And, with me, I was like, one of my biggest goals is to, we want to get larger, but we want to continue to provide a good experience for our investors. If you look at an Invitation Homes or you look at, the American Homes for Rent, look at their reviews. There's websites dedicated to the nightmare that they've put some people through. We don't want that at all. And that's not just, there's plenty of multifamily properties that have that experience as well. So it comes down to management, but, we want to scale appropriately, and we don't want to create a beast where, we're just pissing people off and, creating a nightmare. And the better you treat people and the better that you manage the properties, the longer they're going to stay. The longer they're going to want to be there. And there's obviously benefits to that as well. So
I completely agree. And, I'd love for you to share, because you've been in the single family rental space for quite a while. You guys have quite a few units. Looking back, Peter, over the last 5-10 years, is there anything that you would have done differently if you could take back time at all?
Wow, you always wish you could raise more capital and buy more assets, and especially when the interest rates were lower, get more of that 30-year fixed at 4% and stuff like that. You know what I mean? But I think we sold a lot of. My partner Ron would answer the question as for him personally, he sold a lot of properties over the year for that quick 100 grand, 200 grand, 50 grand, and moved on to the next one, and probably should have held a lot of those properties instead of selling them, and utilized, refis and over the sale. And, now it is good to have a healthy blend of fix and flips and a healthy blend of buy and holds. And I think that operates the same way in the multifamily space. And I mean, if you can refi or recapitalize and pay your investors back, but continue to hold and have the rental income and the tax advantages, that's great. And that's really our strategy, and what our strategy's been over the last couple of years has been, instead of selling, like, let's just refi. And I mean, if we could be all into a property for 120,000 or less, and it appraises for 180,000, we're getting all of our money back on a 70% loan to value refi, and maybe even more than all of our money. I mean, so, and that's tax free. And I mean, so there's advantage, and we're gonna continue to have tax advantage. We're gonna continue to have the rental income. Fortunately for me, and with the investing with people who've been there, done that, I mean, we haven't really made that mistake with GSP. We've continued to hold a lot, but there's definitely opportunities that we've missed on the fix and flip side because we were so dialed in with buy and hold. And I mean, like, because we see a lot of properties. I think that's probably be one of our biggest goals in 2024, where we see a lot of properties that would really make a lot of sense on the fix and flip side. Maybe they're not a great hold because of tax reasons or whatever it may be, and the numbers just don't make as much sense as a buy and hold, but they make a lot of sense on the fix and flip side. So I think keeping that healthy balance of properties you hold, the properties that you sell, and there's advantages to both sides of the spectrum, but the same thing too, like we've dialed in location wise. If you invest in affordable workforce housing, we were really fortunate. My partner Ron went to school in Maryland, and he was in a fraternity, and some of those guys grew up in that area, stayed around that area, worked in construction. So we got into the Baltimore market. They were our initial relationship. They were our boots on the ground. They were the contractors we used, and they showed us around. All cities, urban metropolitan areas are going to be very location specific. Philadelphia is kind of more neighborhood by neighborhood, whereas Baltimore is like block by block. You know what I mean? Like there could be on the same street, but 100 block is better or worse than another. You know what I mean? So you really, and it's like that in all metropolitan areas. So you really want to know the area. And sometimes, you buy something and you think, oh, this is a great deal, and this will be great, and maybe it is, but it's a little bit more of a headache on the management side than something else. Like we sold a property last year that we wanted to keep as a buy and hold, but it was a corner property. There was a bus stop right there. It was very transient, and it just created issues, from people, just tenants complaining about the bus stop and the noise and things like that. So it ended up being a great fix and flip, and it was worked out in that sense. And that's one of the things I like I said before, I like about single family is you have that ability to do that in the single family space. It's a much easier to make those decisions. Is this property make sense? Does it not make sense? What's the vacancy look like? What's the individual property financials and management, ability and all that kind of stuff? What does it look like? And you can track that and then make those decisions on a quarterly or an annually or semi-annual basis to say, is this something we want to keep? Is this something we want to sell off? Do we want to refi this? What, all that, kind of make those decisions around it. So, it's always a learning experience, and always trying to find ways to collect more and more data to make good decisions.
100%. And I love that you mentioned that, one of Ron's possible regrets, not regrets, but just something he would do differently is hold on to more of those properties. And that's something that we saw in the multifamily space, over the last 6-7 years. The market was going up and people would flip them every year to 2 years, and they'd get a great return for their investors. But,
Yeah.
when looking back, it's like, gosh, I wish I would have held that thing for 5 or 10 years. And if you can refinance, like you were mentioning, I mean, that's tax-free wealth. Those are funds that are coming back to you that aren't taxed. You can deploy them elsewhere, and you can continue to hold on to a great piece of real estate. So I think it's a strategy that everyone should take into consideration. And that comes into that last point that you had mentioned, possibly having multiple exit strategies. Like that property you purchased, you were able to flip it because it didn't work out as a long-term hold. And if you can set yourself up in a way where you accumulate real estate, but you possibly have a couple of exit strategies, you're going to have that much more success, over your career. So before we wrap it up, Peter, I would love to hear, do you have any advice for our listeners, for someone that's looking to get started with their first real estate investment, or someone that's just, looking to deploy capital further into the real estate space?
Sure. My number one piece of advice would be to be honest with yourself. Take that self-assessment and, what are you good at? What are you not good at? And be honest with yourself. You know what I mean? Don't fool yourself. Don't try to act like you're handier than maybe you are, or, and give credit to what you're good at. You know what I mean? A lot of people don't give credit to, what they're good at and stuff like that as well. You know what I mean? So really be honest with yourself. Take an assessment. Are you active? Are you passive? Chances are, if you've gone to the real estate meetings for 5 years and you haven't pulled the trigger on anything, then you're not doing the right thing. You got to just change the strategy a little bit. You know what I mean? It's not that you're in the wrong place or whatever it is. It's just that you gotta, maybe you gotta change the way you look at it. You know what I mean? Maybe instead of fixing and flipping, you should be a lender instead, or whatever it may be. So be honest with yourself and jump in. You know what I mean? This is a learn by doing business. You got to pull the trigger, and that's you're never going to learn more than when you jump in. Obviously do your research, get comfortable, but know that you have to start somewhere, and there are ways to mitigate risk as much as humanly possible when you do get started. I'm very, very risk adverse. Like I said too, like with Ron, I spent just hours and hours, references, just out the wazoo with stuff like that, because the longer you're in this business, the longer you know people, not everybody is who they say they are. You know what I mean? Like, it's just, I've been doing this for over 9 years. I've seen a lot of people come and go, people who didn't surprise me so much, and other people that did. You know what I mean? Like, so you're not going to win them all the time when it comes to relationships, just as much as you're not going to win every property either. You know what I mean? But always look at it as a learning experience, and there are good people out there, and you just got to understand what their values are and what their goals are and how they combine and relate to yours. And then, like I said before, if you could find somebody like a Ron, or somebody who's been around, who's been there, done that, who's gone through the cycles and different economies, and that is extremely helpful. I mean, that has been my number one key to success. When I got in the business, I was fortunate to have that mentor, guide kind of person I could always fall back on, that taught me everything that I could call and depend on and all that kind of stuff. And then, Ron and Wade have been that for me the last couple years, and it's been great, and I've learned a lot, and there's a lot that I can bring to the table too. I would hope that they would say, if they were here with me, they'd say the same thing. You know what I mean? Like, I come at things from a very different perspective, and from an age perspective, and just growing up in a different world and all that kind of stuff. And then just everybody's, how hungry people are, depending on how old or young they are, or what their life experiences have been. So yeah, I would say definitely try to find somebody like that for you, but also realize you got to get out there, and you got to pull the trigger, and you got to, learn by doing.
Makes sense. Well, thanks for that advice. And, Peter, thanks for coming on the show. I truly appreciate it. Some great information. How can our listeners get a hold of you if they want to reach out to you?
Sure. So GSPREI.com is definitely a great place to get started. They could schedule time with me right through there. My phone number is on the site, email's on the site. So I would get started there. A ton of information too on what we do, webinars, podcasts, articles, all that kind of stuff. So I would say start on the site, And then, don't hesitate to reach out, whether you're active or you're passive, whether it's your first day or you've been doing it for 100 years. I'll always love to have the conversation and see what I could do better or how I can help somebody, reach their goals, that kind of thing. So don't be afraid to pick up a phone and call somebody and, have a conversation. And I'm more than happy to talk to people and see how I can help in whatever way is possible.
Awesome. Well, thanks so much, Peter. And thanks so much for everyone for tuning in to another episode of Keeping It Real Estate. Please remember to leave us a rating and review, as it helps us a ton to continue to bring guests on like Peter and to bring great content on. And with that, have a fantastic week and go out there and create some success.
Awesome. Thanks, Mike.